Is an S&P 500 tracker your one-stop shop for investments, or should you be diversifying, maybe a global index fund? In this video, I'm going to take a look and give you access to my free S&P 500 calculation sheet as well. Hello, for those of you that haven't seen me before, my name is Chaz and I'm the Risk On Investor. On this channel, we look at riskier investments and growing a portfolio quickly, and you can follow my 0 to £1 million journey by subscribing to this channel or joining my newsletter in the link below. So let's kick off by looking at what is the S&P 500. The S&P 500 is simply an index which follows the performance of 500 of some of the largest companies based in the United States. The index is what's known as a market capitalization weighted index, which means bigger companies control a greater share of the index, and the market capitalization of a company is simply the number of its outstanding shares times the share price, and that gives the value for a company. So for example, a company that was worth $100 billion will have twice the weighting in the index as a company worth $50 billion. The S&P 500 as we know it today traces its inception back to 1957, which is when Standard & Poor, which is where the S&P comes from, started tracking 500 companies in their index. That means there's almost 70 years worth of data for us to look at and compare against other indices. So should you buy an S&P 500 index tracker, or should you go for a more diversified global tracker? In this video, I'm going to give you reasons why you might choose an S&P 500 index tracker and reasons why you might not, so that you can make up your own mind. So let's look at the reasons for getting an S&P 500 tracker. I've got 4 reasons here. Reason number 1 for going for an S&P 500 tracker over, say, a globally diversified all-world tracker is the fees. It's dirt cheap to get an S&P 500 tracker compared to some more diversified products. If we take Vanguard's S&P 500 tracker with a ticker symbol of VOO or VOO, it has an annual expense ratio of 0.03%, which is basically nothing. And if you invest in that in a platform that doesn't charge fees, like Trading 212 here in the UK, then you're paying virtually nothing every year to hold a big basket of some of the world's largest companies. If we contrast that to a FTSE All-World tracker that Vanguard also offer, the fees for that are around 0.22% at the time of recording. That's around 7 times more than the S&P 500 tracker. Reason number 2 for holding an S&P 500 index tracker is that it gives you great diversification with just one index. If you exclude smaller emerging markets, smaller companies and smaller countries, the US makes up around 60% of the global stock market. If you include those smaller elements, it's around 45%. So by buying a product that tracks the US stock market, you're effectively tracking more than half of the global stock market without the need for any other products. That makes it a really simple one-stop shop for investors. Reason number 3 is that many of the big companies in the S&P 500 get the majority of their earnings outside the US. So where some argue that by having an S&P 500 tracker, you're very concentrated on the US, some of the largest companies, take Apple for example, more of their earnings come from outside the US than they do from inside the US. And for the index as a whole, it averages between 30 and 40% of revenue coming from outside the United States. So you can make the argument that by buying the S&P 500 tracker, it gives you good exposure to the global market, not just the US market. Reason number 4, the S&P 500, because it contains 500 of some of the biggest companies in the US, has a massive exposure to all kinds of different industries, not just IT and tech, but financials, healthcare, and many more. That means that as an index, it's already very diversified across certain industries. And so if certain industries start to outperform, you should still benefit from some of that by holding the S&P 500, because in all likelihood, the S&P 500 will contain companies that operate within that sector. So what are the arguments against buying a tracker product that tracks the S&P 500? I'm going to give you 5 reasons to think about diversifying for more or other products that you might be able to get on the market. So reason number 1 is that even though the S&P 500 is very diversified, you are still making a big bet on the United States outperforming the rest of the world. whilst a lot of the big companies in the S&P 500 actually have more earnings outside the United States, a lot of the companies still have a significant portion of their earnings in the United States. And so by buying an S&P 500 tracker, you're assuming that those companies will either continue to perform at the global rate or above the global rate. And that's not guaranteed. For example, emerging markets, such as the BRICS countries, are expected to outperform the United States in growth over the next decade. By buying an S&P 500 tracker, you don't necessarily get exposure to those markets, and so you may be leaving returns on the table. Reason number 2, if you're not a US investor, like myself, I'm from the UK, then there's currency risk in buying an S&P 500 tracker that isn't hedged for currency. So what does that mean? Well, that means because in my local country, we rely on the pound sterling, that exchange rate will fluctuate against the US dollar. If the pound strengthens against the dollar, we'll get more dollars for our pound, which would be great if I'm going on holiday to the US, but isn't so great for my investments, because it means all the investments are priced in dollar terms, they have to go up more than the currency fluctuation of my pound and dollars for me to get the same return. Vice versa, it also works the other way. If the pound weakens against the dollar, I'll get better returns. And so for the last 10 years or so, the pound has been weakening against the dollar, and so that's juiced up returns for UK investors if you're investing in the S&P 500. But do we know if that will continue? Well, if you're buying an unhedged S&P 500 tracker, you're betting that not only will the S&P 500 perform in line or outperform the global markets, but you're also betting that the pound will continue to devalue or stay the same in its valuation against the dollar. That's just an extra consideration you need to be aware of when choosing whether to go for an S&P 500 tracker or a global tracker. So reason number 3 why you might not choose an S&P 500 tracker and instead go for a globally diversified tracker. Reason 3 is that if a new sector or new mega growth company pops up that's not based in the US, you might miss out on the returns from that company. By their very nature, some of these rapidly emerging sectors are difficult to pick up on early, and so you as an investor might not realise you're missing out on these until it's too late to get the majority of the gains. And so by going for a globally diversified tracker, you not only benefit from a particular country that might have stellar growth, a particular sector that might have stellar growth, or a particular company that might have stellar growth that you would otherwise be missing out on. Reason number 4 why you might choose a global tracker over an S&P 500 tracker is that many people invest in an S&P 500 tracker because it has a lot of the big investment names that we're all familiar with. Apple, Alphabet, Amazon, Meta, etc. A lot of the big tech names that are in our everyday life. But a global tracker also has exposure to those mega cap companies. It's just not as concentrated as it is with the S&P 500. So you still get the benefit of the gains from those companies, but it does mean that if the big companies outperform the rest of the market, you don't have quite the same upside as the S&P 500. But likewise, if they underperform, you actually benefit from that as a more globally diversified investor. Reason number 5 why you might go for a global index fund versus just an S&P 500 tracker. The S&P 500 as an index as a whole looks really expensive at the moment. At the time of recording, the price to earnings ratio, which is just a very basic measure of how expensive a business is, a higher number being more expensive, a lower number being cheaper, puts the index as a whole at around 25. That's above its long-term average of around 16 to 18. And that indicates that the US markets are either expected by investors to grow very rapidly, but that's already priced in, or are just very overvalued, maybe because investors value the stability of the US. If we look at, for example, the FTSE 100, which looks at the 100 biggest companies listed on the UK stock market, it currently trades at a PE ratio of around 10.8, so less than half the S&P 500, and the long-term average for the FTSE 100 is around 17. So again, you could make the argument that it's very undervalued just looking at PE as a basic measure. But what about historical returns? Would you have been better historically investing money in the S&P 500 or a global all-world tracker? Unfortunately, there aren't many global trackers that have the same length of history as the S&P 500 to make a comparison, but there are some. So if we look at the year 2000 onwards, which gives us around 20 to 25 years worth of data to look at. If we look at the early 2000s, so 2000 to 2009 as our first 10-year period, in that period, global index funds actually beat the S&P 500 in 7 of the 10 years that we're looking at. But if we fast forward and look at 2010 to 2019, so the preceding 10 years, the S&P 500 actually outperformed the global index fund 8 years out of the 10, so almost the mirror opposite of what happened in the early 2000s. So you'll see there are some periods when global funds outperform and some periods where they underperform. And that's a judgment you as an investor will have to make. Are you happy going for the S&P 500 tracker on the basis that it might continue to outperform as it has done in the last decade? Or would you want to swap to a global fund thinking that maybe the US markets have become overvalued and it's time for a period of global outperformance against the US? But what about wider markets? There are other countries, not just the US, that we could track. Credit Suisse, before they went bust, used to do a yearly analysis of market returns across different portfolio allocations, and that included stock market portfolios. So if we take data from the year 1900 through to 2020, over 100 years worth of data, the best country we could have invested in as investors was actually Australia. Australia outperformed the US over that 120-year period, as this chart shows. Now the outperformance is only small. It's 9.8% against the US's 9.6%, but that can make a big difference over a long period of time. So should we go all in on the Australian market going forward? I've never actually heard anyone advocate for this. Maybe I'm out of touch with the Aussie markets, but it goes to show that we can't always predict what the best stock markets going forward is going to be. So what's my take on this? My personal preference is actually to buy an all-world tracker rather than the S&P 500. Yes, it costs a little bit more, but I'm not willing to make the trade-offs that we've talked about in this video, whether that be currency trade-offs or the continued outperformance of the US. Personally, I do see the US continuing to outperform, but over longer time frames, say 10, 15, 20 plus years, unfortunately my crystal ball isn't working at the moment and I don't know what's going to outperform and what's not. So for me, a global fund is just the set and forget method. However, I don't think there's really much in it. I think if you wanted to buy the S&P 500, you might get very similar returns or even outperform the global funds over the next 10 years. At the current moment in time, the US looks very strong compared to the rest of the world, both in terms of productivity, the labour force, and just the efficiency of the capital markets in the US compared to the rest of the world. And so if you're trying to juice out the most returns you can, it might make sense to go for an S&P 500 tracker over a global fund because those fees are just that little bit lower, and an extra 0.2% per year compounded over 15, 20 years could make a sizable difference to your portfolio at the end of the day. Now I have put together a little spreadsheet where you can put your own market data in, your own inflation expectations, how much money you want to withdraw from your portfolio, withdrawal rates, etc. That will give you an estimated time frame for when you can retire if you wanted just to invest in the stock market going forward. Now the spreadsheet's actually set up with the S&P 500 data, but there's nothing to stop you inputting data from other stock markets if you wanted. Say you wanted a global index fund, you could put your own return data into that calculator and still see the years that you might be able to retire on based on your starting portfolio balance and a monthly contribution. You can access that via the link in the description. It'd be really great to see what your outputs are. With about £500 a month with some of the data I'm looking at, it would put me retiring in around 30 to 35 years' time, given market data. Now, if you know this channel, you'll know that's longer than I'm willing to wait, and the whole purpose of this channel is to look at riskier investments to speed that up. If you want to join me on my journey as I try to build a £1 million portfolio, then you can join my free newsletter in the description below, where you'll get market analysis and insight from me every week and extra data about my journey that isn't shared here on YouTube. Thanks very much for watching, and I'll see you again soon.